Okay, let's unpack this. Today we're diving deep into Snowflake, their Q2 fiscal year 2026 earnings and what they're projecting.
Right. And our mission is really to pull out the key nuggets for you so you get a clear picture fast on, where Snowflake stands and where it might be heading.
Exactly. So let's jump straight into those core numbers for their second quarter. This wrapped up July 31st, 2025. First up, product revenue, $1.09 billion. That's showing a 32% year-over-year growth.
Yeah, that's a solid number.
And total revenue wasn't far behind, right?
Yeah.
Hit $1.1 billion, also up 32%.
Consistent there.
And then there's the remaining performance obligations, RPO they call it, came in at a pretty substantial $6.9 billion.
Right, and that's up 33% year over year. So growth across the board, really, on those headlines.
These are strong figures, definitely. But what do they really tell us, especially that product revenue number?
Well, this isn't just a minor detail, right? Focusing on product revenue is like core to understanding Snowflake.
Yeah.
It's all about their consumption model, that 32% growth. It's critical because unlike, traditional software deals.
Or you might pay for stuff you don't use, shelfware.
Exactly, shelfware. With Snowflake, customers pay only when they actually use compute, storage, data transfer. So 32% growth there is like direct proof customers are getting real value. They're expanding workloads, embedding Snowflake deeper. It's organic growth driven by value, not just contract obligations.
Okay, that distinction is super important. It really ties their success directly to customer success.
Yeah.
But what about that RPO figure then? $6.9 billion, up 33%.
Yeah.
Why is that significant for a consumption company? Seems almost counterintuitive.
Yeah, you might think so, but that $6.9 billion RPO up 33%, it's actually a really crucial forward-looking indicator for them. Think of RPO as their backlog, right? Future consumption customers have committed to, even if they haven't used it yet.
Ah, okay, so it's pre-sold usage, essentially.
Pretty much. And seeing it grow strongly alongside that immediate product revenue means they're not just getting new customers, but existing ones are signing bigger, maybe longer-term deals. It gives them a buffer, some predictability in their revenue stream, which is gold in a consumption model where usage can fluctuate day to day.
Right, so it provides stability. Makes sense. Investors probably like seeing that. Okay, so beyond those top-line financials, what about customer engagement? That's often the real health check for a platform, isn't it?
Absolutely.
How sticky is Snowflake? Let's look at customer growth and retention. That net revenue retention rate, 125%.
Yeah.
Is that as good as it sounds?
Oh, yeah, it's exceptionally strong, especially for a company their size. 125% means your average existing customer isn't just staying, they're actually spending 25% more year over year.
Wow.
Yeah, so they're expanding use cases, bringing in more data, integrating Snowflake more deeply. It's a huge vote of confidence in the value they're getting.
That really speaks volumes. And what about the big spenders? Did we see growth there? They mentioned customers with over $1 million in product revenue. 654 of them now.
Yep, 654, and that's up 30% year over year.
And the Forbes Global 2000 list.
751 customers there, growing about 5%.
Okay, so landing the big fish and growing with them.
Exactly. It reinforces that story of deep platform adoption, the growth in million-dollar clients, the Global 2000. It shows they're succeeding with the most strategic, demanding customers. These companies have complex needs, and their increased spend suggests that Snowflake is becoming, pretty indispensable to their data strategy, not just another tool.
Indispensable is a strong word. Okay, so growth looks solid, engagement seems high, but how efficient are they being while scaling? Let's shift to the non-GAAP figures. People often look at these for a clearer view of core operations, right?
They strip out certain items.
So for Q2 FY26, non-GAAP product gross margin, 76%, non-GAAP operating margin hit 11%, and non-GAAP adjusted free cash flow margin was 6%.
And it's always worth asking, why non-GAAP? Basically, these numbers exclude things like stock-based compensation, amortization from acquisitions, stuff that might be non-cash or not part of the regular day-to-day operations. Companies feel it gives a better view of the core business performance. So for you, the listener, it's like seeing the engine without some of the accounting noise around it.
Got it. A clearer operational lens. So how do those specific margins look through that lens? 76%, 11%, 6%?
The 76% product gross margin, that's quite healthy, shows good economics on their core offering. And the 11% operating margin is interesting, too. They highlighted it's an improvement for Q2 compared to past years.
Okay, so efficiency is improving.
It signals that, yeah. A real effort to balance that growth we talked about with becoming more efficient, getting more leverage from their revenue. And the 6% adjusted free cash flow margin, while it's lower than the operating margin, it's still positive cash generation, which is, fundamental, shows the efficiency is turning into actual cash.
Okay, so not just growth at all costs, they're managing the bottom line too. Now let's pivot. Enough looking back. What about looking forward? Snowflake gave guidance too. Started with the next quarter, Q3 Fiscal 26. What were they projecting?
Okay, for Q3, they're guiding product revenue between $1.125 billion and $1.130 billion.
Which translates to?
About 25% to 26% year-over-year growth.
Okay, so a slight moderation from Q2's 32%, but still strong.
Exactly. Still very robust growth. Maybe shows a bit of caution or just the reality of scaling at this size.
And profitability for Q3?
They're guiding for a non-GAAP operating income margin of 9%.
Down slightly from Q2's 11%.
Yeah, a tick down, but still positive, and shows that continued focus on balancing growth and profit. They also mentioned weighted average shares around 374 million for calculating non-GAAP EPS.
Right, the share count. Good note. Okay, so that's Q3. What about the big picture, the full fiscal year 2026? They updated that guidance too.
They did. For the full year, FY26, they're now expecting product revenue to hit $4.395 billion.
And the growth rate on that?
That implies about 27% year-over-year growth for the full year.
Okay, so pretty consistent with the Q3 guidance range.
Yeah, it suggests a sustained trajectory. And the margins. Full-year non-GAAP product gross margin guidance is 75%.
Still strong.
Very. Full-year non-GAAP operating margin guided at 9%.
Matching the Q3 guidance level.
And maybe most interestingly, the full-year non-GAAP adjusted free cash flow margin guidance is 25%.
Wow, 25% free cash flow margin. That's quite high compared to the operating margin.
It is. It often reflects things like upfront payments from customers on multi-year deals, stock-based comp add-backs, and CapEx timings. It signals strong cash generation capability over the year.
Okay, and the full year share count?
Around 372 million, pretty close to the Q3 number.
So connecting the dots on this full year guidance, sustained growth, decent operating profit, but really strong free cash flow.
Precisely. It paints a picture of maybe a more mature growth phase. Still growing fast at 27%, but with a very clear, unwavering focus on profitability and, importantly, cash generation. That 25% free cash flow margin is key for long-term health, for funding innovation, potential M&A, whatever. It shows confidence in their model's efficiency.
Makes sense. It suggests they're integrating growth and efficiency, not trading one for the other.
Yeah.
Okay, we've dissected the numbers, the guidance, but let's talk about what drives this, what's fundamentally underpinning these results. We touched on it, but let's really nail down this consumption model. It's unique, right?
Absolutely game-changing, really. Unlike traditional software where, like you said, you might pay for shelfware.
Yeah, pay for a license whether you use it or not.
Right. Snowflake customers pay based on actual usage, compute, storage, data transfer. It directly aligns their costs with the value they get.
And why is that so powerful for Snowflake?
Well, it removes the customer's risk of overbuying, and it creates this amazing flywheel. The more value customers find, the more they use, the more Snowflake earns. Organically. It means revenue can grow just from increased usage by existing customers without needing huge new sales pushes all the time. Makes the relationship stickier, too.
Because the value is obvious.
Exactly. And that's why product revenue is their #1 metric. It shows current value delivery. And RPO shows the committed future value delivery.
A win-win structure, it seems.
Yeah.
So how are they actively driving more consumption? Especially with this whole AI data cloud push.
Good question. It's not passive. It's deeply tied into that AI data cloud strategy. And they gave some specific metrics there, too, which are quite telling.
Oh, yeah. Like what?
Well, for instance, they said 40% of their customers now have at least one stable edge for data sharing.
A stable edge, what does that mean?
It's not just a casual share. It means a share connection that produced at least 20 processing jobs over 2 successive 3-week periods. So it indicates sustained, active collaboration.
Okay, so serious data sharing is happening.
And that's up 21% year over year. Plus, they mentioned 400 listings now in their marketplace.
That stable edge metric feels significant. It's not just storing data, it's actively using it together.
Exactly. It points to a real network effect. Customers aren't just siloed, they're collaborating, sharing data, leveraging apps from the marketplace. A stable edge means data sharing is becoming embedded in workflows, potentially intercompany workflows. That's huge. It means more data flowing, more processing, more consumption, driving that AI data cloud vision. It's about building a whole data economy on their platform.
Right, turning the platform into a hub, not just a warehouse. Okay, it's clear the strategy is driving usage. But we have to mention the caveats, right? Financial guidance always comes with warnings.
Absolutely crucial. The safe harbor statement, these are projections, hopes based on current info, not guarantees.
But what kind of risks did the source material mention? What should you, the listener, keep in mind?
Well, they list various known and unknown risks. Standard stuff like general economic conditions. If companies tighten belts, consumption could slow down. That's a real factor for a usage-based model. Another big one they often mention is customer consumption optimization.
Meaning customers get smarter about using the platform.
Exactly. As they get better, they might find ways to do the same work using fewer resources, which is great for them, but could temper Snowflake's revenue growth for that specific workload.
A double-edged sword, kind of. What else?
Competition, obviously. The data cloud space is fierce. New features and pricing changes, how the market reacts is never certain. And adapting to new tech, especially AI, the pace is just relentless. They need to stay ahead of the curve with their AI data cloud strategy to remain competitive. So yeah, positive outlook, but always risks involved.
Good context to keep in mind. Okay, what a deep dive. We've really unpacked Snowflake's Q2. We've seen strong results, ambitious, but, measured guidance for fiscal 26. It seems driven by that unique consumption model and a real focus on the AI data cloud. So for you listening, the big takeaway seems to be this balance they're striking. Strong growth, yes, but also increasing efficiency and driving deeper customer engagement through things like data sharing. That combo is pretty critical today.
Absolutely. And ultimately, this deep dive leaves us with maybe an important question for you to think about. As Snowflake keeps pushing this idea of connected, trusted, easy data infrastructure, how will that continue to shape the competitive landscape, especially as their AI data cloud matures and we see more specialized industry-specific AI solutions pop up? Where do they fit in that evolving picture? That's definitely something to chew on until our next deep dive.